Hi, and welcome to Boom It's on the Blockchain. And we are back with our favorite guest, the very first guest on the show for the 89th show now, Adam Blumberg. How are you doing, Adam?
I'm doing great, Alistair. And yeah, I forgot I was the first guest. So we could actually take your podcast and determine things like how much hair I've lost, how many more grays I have, all of that through bull and bear markets in crypto, right?
Yeah. There's nothing what the bull and bear markets bring to crypto anyway. So just to kick things off then, Adam, just to give a bit of background and update what's been happening with yourself over the last couple of years.
Well, the update is, my focus is on helping financial professionals. So that's financial advisors, accountants, bankers, attorneys understand how Bitcoin, crypto, blockchain all work, so that they can start helping their clients out. As you know, it's kind of a different animal from the traditional financial system, from the traditional rails that we've been using for so long. And so my goal as a former financial advisor, my goal is to help them understand how it all works in a way that we're not trying to force them to get their clients to invest. We're not shilling any particular tokens or anything like that. It's just, here's how it works. Here's how you might want to help your clients now. Here's what you might want to do to help your clients now. And based on that, here's what we think is coming. So you better get yourself and your practice prepared for the next year, 5 years, 10 years, so that you can be ready to help those clients that are going to have assets on chain, that are going to have crypto, they're going to have an interest in that, so that you can better understand it.
Perfect. So, well, let's kick things off with Bitcoin then. So, obviously, if you look at Bitcoin price today is 42,000. The news of the Bitcoin ETFs that went on for the last 18 months was coming in. And when it did come in, the Bitcoin price just essentially just stayed the same, went down a little bit. So, but I'm sure in the future it's going to go up. So, to begin with, Adam, can you explain a little bit about the significance of Bitcoin ETFs, especially BlackRock's one, and where you see the Bitcoin market going from here?
Well, the significant, Alistair, of the Bitcoin ETFs is, one, it brought those traditional players into the Bitcoin and crypto world. So it brought, you mentioned BlackRock, Fidelity, Franklin Templeton, and these are companies, some of which were actually kind of in the crypto world. Fidelity, Franklin Templeton have actually been pretty heavy in the crypto world for a while. BlackRock, of course, jumped in feet first. I mean, they're just all in, apparently, according to Larry Fink. But the significance of it is, again, bringing those traditional players that have their trillions and trillions of dollars of assets under management to where they can start allocating a little bit into crypto exposure. And of course, the Bitcoin spot ETFs give us crypto exposure. So that's part of the significance, is it opens up trillions and trillions of dollars that are being managed on these custodians or through these fund companies to crypto exposure. And in the past, what we've seen, Alistair, as you well know, is we've had larger investors that have been heavily crypto, those that were early crypto adopters that have been into it. Then you've had people that dabbled in it during the big bull runs in say 2017, 2018, or in 2021 that kind of dabbled in it a little bit. Now what we have is kind of easier exposure to the price of Bitcoin via these ETFs. So that's number one. Bring in these traditional money managers, traditional custodians. Then the next step to me in terms of the impact on Bitcoin and the impact on crypto overall, but specifically Bitcoin, as you all know, the point of Bitcoin, or one of the points of Bitcoin, is there is this verifiably scarce amount. There will only ever be 21 million Bitcoin ever created. And a spot ETF, a spot Bitcoin ETF, significantly impacts the demand for a scarce asset. All right, that means the demand for the Bitcoin spot ETFs now and in the future directly impacts the demand for for Bitcoin. And as you well know, there are very, very few Bitcoin that are available to trade. So there's any Bitcoin that's available. Of course, Satoshi is not selling his Bitcoin. Michael Saylor's not selling his Bitcoin. So who else is going to sell? And those that want to buy into the Bitcoin spot ETFs are actually directly making those fund companies go into the market and buy more Bitcoin. And we've already seen the numbers. I know Bitwise kind of publishes their numbers every day. They actually publish their wallet address so we can go watch it. But they talk about how many Bitcoin they've had to go buy in the market to satisfy the demand of their ETFs. So again, one is these traditional players getting in. Two is the Bitcoin spot ETFs have a direct impact on the demand for Bitcoin and therefore the price of Bitcoin because of the fixed supply. The third point I'll get to is it kind of signals a loosening of regulation in the US around Bitcoin and around crypto. The SEC was staunchly digging their heels in around crypto for so long, not allowing spot ETFs, actually coming out and saying they feel like crypto is there for scams and laundering money and criminal activity and such. Even though you and I and many of the people who understand crypto know that that's really not the case so much, but they were staunchly digging their heels in. They either because they were forced to, or they chose to kind of let up a little bit here with the Bitcoin spot ETFs. I think that's a signal of regulatory easing here in the US, which means we might very well see an ETH ETF soon. It means we might see other regulations kind of loosen up, whether that's through the Department of Labor and 401k rules, whether that is through the Fed, the Fed and the Treasury Department, through the OCC or whatever it might be, kind of a loosening because when all these other firms can go to whoever the regulator is and say, hey, the SEC allowed the spot ETF, I guess crypto's okay. It's kind of a signal of maybe some loosening of regulatory policy.
So thinking about the Bitcoin ETFs, how many Bitcoins have they acquired in that short period of time? Do you have an approximate amount?
I don't even know. I could probably do the math pretty quickly, but I believe there's been roughly, something like maybe $5 or $6 billion worth of inflows as of right now when you and I are talking, which is Monday, January 29th. I think there's been like $5 billion worth of inflows into those ETFs. Of course, there have been outflows from Grayscale, from GBTC, but I honestly couldn't tell you, Alistair, and I wouldn't even pretend to know. That's data that's readily available, and you and I could probably find it pretty quickly. But I don't know how many Bitcoin they've had to go into the open market and acquire, but it's a relatively significant amount.
So why has the price not risen really then? Or was it the speculation before this happening that pushed the price up? And then what's your thoughts behind that?
There was some of that speculation, right, which moved the price up. And if we, look at a chart from, say, we could go back to September of last year, which isn't that far off, price was at around 25,000. So from 25,000 going up to 49,000 the day that the ETFs actually launched, that's a pretty good run up in price, right? So there was, I think, a lot of an investment in speculation, as I call the micro investment, which says all we're doing is buying Bitcoin, thinking that there's going to be an ETF approval. And once there's an ETF approval, we're going to sell because that's all we were looking for. We're not concerned with these very long term. We don't care about Bitcoin as a store of value or inflation hedge or anything. We just want that short term gain. Right. So there was some of that selling based on that. Part of it, a huge portion of this was due to Grayscale. And of course, Grayscale had GBTC, which was the Grayscale Bitcoin Trust, which had about $28 billion worth of assets in it, which was not an ETF. Now, when on that date that the ETFs started trading, most of the ETFs had about 0.2% in fees. Right. So if I bought the Bitcoin spot ETF from BlackRock or Fidelity or Bitwise or whomever else, I would be paying, about 0.2% of my assets in fees. Grayscale, on the other hand, converted GBTC, or the Grayscale Bitcoin Trust, from a trust to an ETF, but they had 1.5% fees. So the difference between 0.2 and 1.5 meant a whole lot of people were selling their Grayscale shares, selling their GBTC, and either just selling it and taking their profit, or moving into one of those other funds, or plan to move into BlackRock or Fidelity or Bitwise or Franklin Templeton. Now, the difference between Grayscale having a trust like they had before and having an ETF is when they had a trust, they didn't necessarily have to buy and sell Bitcoin based on inflows into the actual fund, right? They could hold a same amount of Bitcoin, and the price of the fund could move up and down independently of the price of Bitcoin. So oftentimes Grayscale or GBTC would trade at a discount for the last couple of years, but at times when there was major bull markets like 2021, GBTC was trading at a premium. Okay, now when there's an ETF, they have to have an amount of Bitcoin in their treasury or in the vaults that's kind of on par with the value that's in the ETF. So as people started selling shares of GBTC because they didn't like that 1.5% fee, Grayscale had to go into the market and start selling a bunch of their Bitcoin. So I believe they went from $28 billion in assets under management to about $20 billion in assets under management. So it's an $8 billion outflow in Bitcoin that they had to go sell on the market. And the other funds just hadn't taken that up as much yet. They didn't have the ability to bring in $8 billion in inflow. So some of the GBTC was people taking profit. And some of it is people either now or in the future looking to move into these other funds. And maybe they're waiting for the price to kind of level out and figure out where they are. So that's kind of the main catalyst for the price not going up, for it moving down, because this is an asset that we've never experienced, an asset with this level of liquidity trading 24/7, 365 all over the world. And this is just what happened, is one major player was forced to sell quite a bit, and everyone knew it, right? So it's not like the likes of Michael Saylor or someone is going to step in and buy it at 45,000 when they know full well Grayscale is going to have to keep selling and the price is going to go down. The other part, real quick, Alistair, that I think impacts the price is Bitcoin miners started selling a bunch of their Bitcoin. I think because the price had gone up, because they're not quite sure what's going to happen between now and April. And of course, in April is supposed to be the next halving event, meaning in April, once that halving event happens, once the amount of supply, once the Bitcoin block reward gets cut in half, the production, the product that all those Bitcoin miners have, which they all have the exact same product, and that product is Bitcoin. The value of their product, or the amount of their product they're going to create, is going to get cut in half starting in April, or starting towards the end of April. So I think what a lot of them are doing is they were selling a bunch of the Bitcoin they had in their treasury for cash, so that they can have the cash available once their production gets cut in half to continue to pay their bills, so that they're not stuck in a time when the price of Bitcoin maybe stays where it is. But again, because they're producing half as much Bitcoin, they don't want to have to sell all their Bitcoin at that point to try to pay their bills. So I think they were getting out at a time when the price had gone up, so that they can save some of their cash, so that they can continue to pay their bills and accumulate the Bitcoin that they produce starting after April, and not have to sell it knowing full well that they're going to produce about half as much. So I think the Bitcoin miners have learned from cash flow mistakes of the past, and they're making sure that they have some cash available on hand to pay their bills in April, May, June, before the price goes up and takes up that slack in the amount of production they're going to have.
Yeah, so from a Bitcoin miner's point of view, when the Bitcoin halving starts, then essentially their profit margin is going to be basically cut in half. 50%.
It's going to be cut in half for a little while, yes, until the price of Bitcoin hopefully
goes
moves up to take that into account.
And if you look historically, Bitcoin, when there's a halving, within 18 months of the halving, it's sort of doubled in price.
Right, but they're not necessarily counting on that to happen right away.
Yeah.
Nor do they know what other market factors are going to be, right? So now they're operating as real companies, which I think is a positive step. They're not saying, because remember, their output, the value of their company, their revenue is 100% tied to the price of Bitcoin. So what these companies now are saying, especially since many of them are publicly traded companies like Riot and Marathon and such, they're going, look, we can't have our treasury also subject to the volatility in the market factors of Bitcoin. We need to have dollars in our treasury because our expenses are denoted in dollars. So we need to have that sitting in the bank waiting to pay our bills. we can't have both our revenue and our treasury subject to the market ups and downs of the price of Bitcoin. So you're right. It's not necessarily their profit margin will be cut in half. Their revenue gets cut in half starting at the end of April.
Yeah. So then the profit margin could be, well, you don't know. It depends on what their
outlay
of costs.
And their margin likely goes down as well, but I don't know what they've done to offset some of that profit margin. I don't know if they're able to lower their expenses somehow, but it seems like they're probably not. But I think having cash on hand so that they can be ready to pay their bills and continue to produce Bitcoin is what they're going for.
And you think this is going to take a lot of the home miners now? It's where it's just become industrial and Bitcoin mining.
I think that's a worry, and I'm guessing that's what's going to happen. I mean, we've had Bitcoin miners. I say me and my business partner, we've had Bitcoin miners. We've had to turn them off for a while because of the cost of electricity as opposed to the price of Bitcoin. And starting in April, we would definitely have to turn them off because we wouldn't be producing as much. So I think the smaller miners are going to have a tougher and tougher time competing. And what you're mainly going to say is what you're mainly going to see is more of these huge industrial, publicly traded miners able to continue to grow and grow and grow, because those of us that are smaller are not going to have access to the capital, access to the economies of scale that they have, access to the energy that they have, and the low cost miners and such. So I think with the halving, you're going to see more of it moving onto these publicly traded and kind of industrial miners.
Essentially, the Bitcoin market now has people like BlackRock coming in, Vanguard, etc. Do you think this is going to speed up the adoption of blockchain technology and other cryptocurrencies, or how do you see the rest of the market look because of what's happening in Bitcoin?
Again, I think it is going to help, because what's going to happen is more people are going to be invested. More, I talk to financial advisors and financial professionals. More of them are going to have to get educated because their clients are going to be interested. And once you kind of start going down that rabbit hole, it's really hard to stop. And you learn more about, Bitcoin, blockchains. Maybe you get into, smart contracts, Ethereum, Solana, and other networks. And I think that's going to help. And again, as I said before, talking about the SEC approval of the ETFs, it's likely going to open up more positive regulation towards other crypto assets, towards Ethereum, towards smart contracts, towards stable coins. So I think what's happening with the Bitcoin spot ETF is going to help. And remember, of those, as we call them, traditional finance companies that got approved for Bitcoin spot ETFs, you have BlackRock, which is the world's largest asset manager. And Larry Fink, the founder of BlackRock, has been talking quite a bit about tokenization and about how this is just one step in tokenizing more and more assets, and they're likely going to, tokenize some funds here in the near future. Fidelity has been custodying Bitcoin and ETH for quite a while, and they're going to be talking about, tokenizing assets, and they're very versed in crypto custody. Franklin Templeton, I know, they've been doing things like Bitcoin mining, operating validator nodes on various crypto networks. They're going to tokenize assets. They do some asset management in the crypto and DeFi space. Bitwise, of course, is right now the number 3 ETF, and they're a crypto native company. So they are going to be, I think, versed in tokenizing assets and in offering ETFs with other crypto exposure. So I think what this is going to do is bring all that traditional money and traditional financial thinking and going, look, we can utilize this technology. Even if we're not trading crypto assets like Bitcoin and ETH, we can utilize this technology to tokenize various assets. And then once we get those assets on chain, let's open up and see what else we can do once we're on chain. It's a little bit, Alistair, like the early days of the internet, which, as you remember, meant that initially with the internet, it was just I could buy and sell books, which I could also go do at a bookstore, or I could view newspaper articles that I could just as easily read in the newspaper online. That was the beginning of it. So it was just basically a replication of what we did. And then it became, okay, once we're online, now what do we do next? And what do we do next? And what do we do next? And here you and I are in different parts of the country speaking, recording this podcast that's going to be distributed in multiple ways via the internet. And that all came from the early days of doing things that were online, which were essentially repetitive to what we could get in, in kind of the real world or in-person economy. Same thing I think is going to happen. And this is just like that first step. So this to me is the kind of the equivalent of almost of selling books online, of Amazon selling books online or something, where this is the very beginning. This is what's going to get people into it. And once you're there, then it's going to be interesting to see, once we have that level of understanding and adoption, where we go with it next.
Yeah, that's super interesting. And then just explain to people, obviously I was involved in tokenization of energy assets. We're talking about tokenization of real estate assets, but speak a little bit about how the tokenization of funds is going to be really interesting to the financial community.
Okay, well, that's going to be really interesting. So if you take a fund, so say BlackRock has a real estate fund or something like that's going to be tokenized. So on the surface, you might go, what difference does it make to me? I don't really care if they tokenize the fund, how they account for it, because basically what it's going to do is taking a BlackRock fund, and instead of having it denoted on one of their servers, right, in their siloed database, they're going to say, all right, we're going to put the denotion of this particular fund on a publicly traded on a public blockchain, right? And that means, for anyone who's watching that doesn't understand what that means basically, instead of it living within the BlackRock database, it's on this kind of public database, but it's still going to have kind of the same information there, right? So one for one, it's not that much different. It's just how are you keeping track of my ownership, or how are you keeping track of this share of this fund? But then again, once you have that level of adoption, where it goes a little farther is things like, okay, once it's available on a public blockchain, then theoretically, instead of only being able to hold that within some sort of traditional custody, like within Fidelity or Schwab or BNY Mellon or something like that, I can theoretically hold it in my own wallet. I can custody that asset myself. So I can hold the BlackRock real estate fund token in my own wallet. So I have custody of it. That means I have full control. I can move it where I want to. I can show my financial advisor, my accountant, whomever, that I now have full control over it. Okay, so that's step one. Once I have that, that means theoretically I can do something like use it as collateral to get a loan. And I'm not saying that someone is necessarily going to be a DeFi degen, right? They're not going to go borrowing money against their real estate, their BlackRock real estate tokens, so that they can go buy more real estate tokens and leverage themselves that way. But what it does, Alistair, is it gives me more options. So if I have assets in a brokerage account that might be a BlackRock real estate fund, and I have assets in the bank, which might be dollars, and I have other assets, I'm very limited into where I can get cash. Usually if I need to spend money, for instance, if I have if I got to pay for my daughter's wedding or pay for a car or something, I sell assets, or I use whatever I have in the bank to pay for that, to pay for the wedding or to pay for the car, or I go get a loan for it. But when I have the option to utilize my other funds, like a tokenized version of a BlackRock real estate fund as collateral, maybe that's where I go borrow the money. Maybe I use that as collateral and go borrow that money. And that's how I pay for the wedding. And that's how I pay for the car, because that's going to create more competition in the lending space. Okay, because those assets can be utilized as collateral. The other, some other ways that I see it being impactful is, you and I both know about the transparency of public blockchains, the amount of data that you can see up to the second. Whereas for most traditional finance companies, if they're publicly traded companies, we get to see their data once a quarter at the most, right? That's where we get to really understand what's going on behind the scenes and on their books, everything like that. It's about once a quarter. For some private funds, we never really get to see it. If they're nice enough to share the information, every so often we get to see it. What we're going to get, I think, is much more transparency. So I'm going to know up to the minute what is happening with this tokenized fund, because they might have data feeding on chain to show me, here's the real estate portfolio we own. Here's how much income we're getting. Here's how much debt we have. Here's the underlying value of the real estate assets. And therefore, I'm going to be much more informed as to the value of those assets that I hold. And then we have the idea of more liquidity, right? Because these funds don't necessarily only have to be traded within the BlackRock ecosystem or only within the Fidelity ecosystem, because they're available publicly or on a public chain or a public network, I might have more liquidity available. I might have more opportunity to sell some of these funds, part of my investment or all of my investment at any point. And remember, the person I'm selling it to is going to have much more purview into, or much more visibility into the value because of that transparency I just talked about. So all these aspects of public blockchains that we like, right? The immediate settlement, the ability to custody my own assets, the liquidity, the transparency, the self-custody, all of those aspects that we like are going to come to these funds that BlackRock or Fidelity or others might have available that are going to be tokenized. Now, they're not going to come immediately, but that's the kind of adoption that we might see progress through the system in the next 5 or 10 years.
Yeah, so real adoption, because it's like a false dawn quite a lot, Adam. So
Right.
It's like tokenization of energy assets. When we first started doing it, I thought everyone would do it. Pitched it to all the big operators. Yeah, we like your idea. We can see the benefits, but oil price is high, so good idea. Keep it in the back pocket. We'll come back to you when we're interested in that. When you're involved in a startup and you're building something, and then suddenly you hit a wall like that, it's not very easy, So it's like inventing something you think is going to work, and then suddenly the market doesn't adopt it. But I think from tokenization, it's been like that with the token exchanges. It's just, there's very few people on it. Again, it's high net worth people coming in. But just explain the difference between the liquidity with a traditional fund and the potential liquidity from a tokenized fund, so people can see the difference and be able to access your money compared to the traditional finance route.
Well, yeah, and we can talk about this from the perspective of the real liquidity of a traditional fund versus the theoretical liquidity of a tokenized fund. So in the traditional funds, if you buy kind of a publicly traded fund, we would call it could be an ETF or some other fund, again through BlackRock or JP Morgan or Franklin Templeton or wherever, they're pretty much liquid based on the market, during market trading hours, within those relatively small networks, right? Who else wants to buy the BlackRock real estate fund today? And by the way, we have to go through traditional methods to be able to trade this. If it's a publicly traded fund. If it's a private fund, so if I get in on a private real estate fund or a private oil and gas fund, there's virtually no liquidity for that. And when I buy into those, I know that I might get some income from it. I might be getting periodic income quarterly from it. And again, this is talking about private funds. And what I'm hoping for is eventually that entire fund gets liquidated, meaning someone else comes in and buys the portfolio or buys the fund. And then I get this, this rush of capital in addition to whatever income I've generated over that period of time. Right. But with private funds, there's virtually no liquidity. And part of the reason why, of course, is because the managers of those funds, whether they're real estate experts or oil and gas experts or private credit experts or whatever they might be, they don't have time to go calculate the value, and they don't have time to repaper it. If I'm selling part of my private investment to you, that's a pain from a legal perspective. That's a lot of paperwork. That's making sure that Alistair is an accredited investor and is going to buy this. And now we have to send all notices to him, and now we have to send income to him. It's a pain. So if I buy into a private fund, I don't really have the opportunity to go sell it to a third party, right? My requirement is usually, if I need to get out, if I need to liquidate my holdings, I need to sell it back to the fund issuer, and they're going to buy it at a pretty steep discount. Okay, so if I'm going to do that, I better really need the money. So when we move to, again, theoretically, when we move to tokenization, if we're talking about public funds, public funds like a publicly traded, BlackRock fund, the difference in liquidity might not be so vast because they're already available publicly, meaning I can already, trade them on an exchange during market hours. So maybe what we see is more liquidity after hours. Maybe what we see is the ability to do actually a peer-to-peer transfer of a publicly traded fund. When we start talking about private funds, so if I buy a private real estate or oil and gas or private credit fund, now I might have the ability to be able to sell it to you even without asking the permission of the fund managers. And the reason why, because all that legality is going to be included in the token. So when I sell it to you, when I sell my token to you, and now that token is in your wallet versus my wallet, the issuing company, the fund, they don't care if it's me or if it's you. They're going to pay their income stream to the wallet that holds that token. They're going to pay the income stream to the owner of that token, and they don't have to necessarily go repaper everything. You, but by virtue of the fact that you're buying the token from me, have probably already had to go through KYC, AML, make sure you're an accredited investor. So again, it's the managers of the fund that no longer have to go check everything and no longer have to repaper and go through the legalities of it. But if I can trade you my token, now there is instantly much more of a liquid market. And again, going back to that idea of transparency, you're going to have a much better idea of what that investment that I made, of that investment that I have in that private company. You're going to have a much better idea of what it's worth and if it fits in your portfolio. And if I invested $1 million in it and I only want to sell a quarter of that because maybe the price has gone up or maybe I need the cash or something, I'm more likely to be able to sell a quarter of my investment to you, and you're happy to have it because you see what the value is, you see how it fits in your portfolio, you see the risk profile and everything. So that to me is theoretically going to create more liquidity. Now, when you and I met, Alistair, back in early 2019, we thought this would have already happened by now. But I think a lot of the issues we've had so far has been with the technology. It's been the adoption or lack of adoption so far. And a lot of that is because of the custody aspect, because of the wallet aspect, safety and security. But a lot of it has also been because of the financialization of crypto and DeFi. And there's been so much more poured into how can I create something like an exchange or a DAO that has a token, and how can that token go up? And that's where more of the VC money has gone. That's where more of the adoption. And it kind of took away from the narrative of tokenizing assets that people want and making them more accessible, making them more efficient, having all that transparency. I think some of that narrative was taken away by people trying to make really, really quick bucks on crypto, DeFi, NFT assets.
Yeah, the NFT market didn't help this because it just sort of muddied the waters a little bit, So because
what I'll say is it helped and it didn't. Okay, it didn't help because again, it created this financialization around digital pictures, right? Digital art. And that spurred all this investment in there, and that's what people were talking about. And then, of course, when the market came crashing down, a lot of people lost money, and it was a really bad narrative. I think the positive to it was people started understanding the idea of verifiable scarcity. They started to get in, and I think it's what got a lot of people interested in this digital asset world, and the fact that digital assets don't have to be Bitcoin and ETH. They can be something like a token that represents a piece of art. Or in the case of NBA Top Shots, it's a token that represents a particular moment. And I can verify that there are only 50 of those moments created. So on the negative, yes, it was a lot of money that went in. It was a lot of money that people lost. We got to talk about how, some people got to talk about how ridiculous it is, people paying millions of dollars for a digital image of a digital pixelated image of an ape. However, those are the kind of things that you have to do to move adoption. You have to have money flowing in. And yes, only 5% of what came out of that is going to be impactful, but that 5% is going to be huge. If I go back to the internet, it's the equivalent of Amazon growing the way they grew. But how many other companies tried to do what Amazon did and didn't make it, right? I mean, pets.com is a famous example of that, where they were just early. We just weren't ready for something like that. But now, how many companies do you have selling pet goods or pet food or something online, and they're wildly profitable? Whereas back in 2000, it didn't work. you needed that with the internet, and you needed that with crypto, because you had all these companies or protocols or DAOs or NFT projects raising a bunch of money, and it's going to drive a little bit of adoption. It's going to drive a little bit of innovation, but that adoption and innovation is going to end up with massive returns. And I don't mean dollar returns. I mean massive returns in terms of the number of people adopting and understanding, and the progression of the networks. So yes, it was a little bit of an aside in terms of what we think where we think the innovation should have gone. However, it is what it is. And part of the beautiful thing about crypto and blockchains is they're meant to be so decentralized, and they're meant to be so capitalist. And you're supposed to go, all right, we're going to go where the market takes us. And yes, I don't like the fact that there were billions of dollars spent and probably lost in the NFT boom and bust, but it's just a necessary part of what the market have to do. Just like, honestly, Alistair, I'm not a huge fan of Bitcoin spot ETFs. I think it takes away from the innovation that is Bitcoin. However, it's a necessary part. It's a necessary next step to get to more adoption.
Yeah, and it brings trust from institutional investors into the market space. And I think that sort of slowed up the adoption from when we were talking about it back 2019, and coming in terms of energy companies that adopt it. But, there's more and more sort of innovation coming to it as well. And spoke about Bitcoin mining to begin with. I think, that's key, that you've got more energy companies. We were talking about flaring of gas as well offline, and be able to access the flaring of gas and use that to basically run the mining units, the Bitcoin miners. And then suddenly your cost of electricity comes down to minimal, and that's your big variable cost in doing it. And then it suddenly becomes profitable. So it's like everything. It's just, as the innovation comes in, it's the adoption going alongside it. And I think what's interesting about the technology is, for a lot of people out there, they're never going to own an asset with property of anything, but this has allowed them to own a digital asset. And that's still an asset that you can actually own, and it sort of opens it up. But we are talking about, the majority of this stuff with tokenization right now is still accredited investors, because that's the way they're getting set up. Mm-hmm. So when do you think the adoption of tokenization is going to come to everyone else in the market space?
I think it'll take a while. It's going to take some changes in regulation, and it's going to take some changes, honestly, in the regulators and the laws, realizing that we can use things like digital identity to understand who people are and how they can invest, to the point that we don't have to violate privacy so much and get so much information on people, that we can actually use this infrastructure to help with the current wealth gap instead of hurting it. Because what you're talking about is the fact that people who are already wealthy have the ability to invest in many of these funds, or many of these projects, or many investments that are going to allow them to get wealthier. And those that are not wealthy don't have the ability to invest in something that's going to help grow their wealth, right? Which creates this wealth gap that keeps growing and growing. So I honestly think the technology is going to be able to help us get to the point where more people are going to be able to invest in something that's going to help them get wealthy, but isn't going to hurt them as much from a risk perspective. And once we see that tokenized versions of assets are not volatile crypto assets, I think once the regulators understand that, then more and more people are going to have the ability to invest in things like tokenized real estate funds from BlackRock, or tokenized oil and gas investments, or tokenized art, right? And I don't mean digital art like Bored Apes, but I mean actually tokenized versions of very important works of art, where you and I might get a fraction of it, but that's part of our investment portfolio. When will it come down? Look, crypto is already available to anybody. Anybody can buy Bitcoin or ETH or any number of crypto assets, which is part of the beautiful part about crypto. As far as when we get to anyone being able to buy tokenized versions of assets that are only available for accredited investors, I think the accredited investors rules have to change. I think, again, the understanding of the transparency, the liquidity, the holding of crypto assets or of tokenized assets is going to have to change. The understanding of it is going to have to change before the kind of average investor is going to be able to have access to it, mainly because the role that the SEC sees for themselves is we kind of have to protect people from themselves. We have to protect them from predatory, predatory firms or companies that are going to try to get everyone and their mother to invest in our fund. And we're going to tell them that they can earn 28% on their money or something like that. And everyone, of course, wants to significantly grow their wealth. And so that's kind of the charge of the SEC is how do we stop that? How do we make this safe for the average investor so that they don't lose their last dime that they would have used to pay their bills in this sort of investment? How can we do that? But again, the transparency of blockchain transactions, the transparency of smart contracts, the transparency of tokenized assets is actually going to help that more than it's going to hurt it. But we need to make sure that those that are in government and regulate understand that.
Bitcoin's seen as a high risk asset. So everything else in crypto for everyone out there, it's going to be a higher risk. And when you start going out with the sort of top 5 cryptocurrencies, then you're really starting to get into high risk assets. But just to sort of finish off the podcast, what other cryptocurrencies out there? And I know, like you spoke about Ethereum and there's Solana or Cardano and the BNB token. Which other cryptocurrencies are interesting to you and you think are going to do well in 2024?
Well, I'll say this first. I don't give predictions. I don't give price targets or anything like that, or tell people.
I meant from a technology perspective.
Right, from a technology. Look, Ethereum is Ethereum, right? It's the second. It's the second largest network. It's probably the second most decentralized behind Bitcoin. There's more developers building for on top of Ethereum and on top of the different layer 2s on top of Ethereum, which is a whole different topic. But there are more developers building for it and more, I think, companies building for it. So that to me is tremendously interesting. Plus, it will likely be the next ETF that's approved. So you have that aspect to it as well. You can stake ETH, so there's a yield earning capacity to it. So I think that's really interesting. I think Solana is interesting because it has, I think, the third most developers building for it. And Solana has built their platform to be fast and cheap. And so many applications need fast and cheap. That's all they really care about. They don't care as much about the decentralization aspect. They care about fast and cheap. And Solana is growing really fast. And yes, Solana has the specter of being attached to FTX and Sam Bankman-Fried quite a bit. But because of that, there was so much investment into the Solana ecosystem and builders for the Solana ecosystem a few years ago, and they just continued building and building and building. So you know very well, in the last several months, we've seen the Solana token, SOL, go up, 25x or something like that, 25x or something. And that doesn't mean it's going to continue to do that, but it's interesting from an adoption standpoint because there's so much building going on the Solana ecosystem, and the applications on Solana are going to be different. They're looking at more gaming applications, more high-speed trading applications, things like that don't necessarily require the same level of decentralization, but need to be fast and cheap. So those would be kind of my big 3 if I were looking at any. On top of that, I like Chainlink is really important and impressive to me because what Chainlink has done is built this protocol that allows for on-chain assets. When I say on-chain assets, the tokenized assets we talked about, but tokenized assets that might be built on top of Ethereum or Solana or Cosmos or something. Chainlink has built this protocol to where they can be interchangeable. They can be built on different blockchains, but can still be traded or moved around or provide that liquidity regardless. And Chainlink has been partnering with the likes of Swift and some of the largest financial institutions in the world to try to bring that. And so they are really interesting to me. Helium in the perspective of DePIN or decentralized physical infrastructure, I think is really interesting to me. And then there's another one that I really like called Maple Finance, which has been building kind of lending capabilities. So basically huge tokenized versions of real world lending on, utilizing blockchain networks. So those are kind of some interesting ones to me that I like and I look at. Again, not because I think that I want the price to go up significantly, but more because of adoption and what they're actually bringing to the infrastructure and the ecosystem.
Yeah, we had Hedera on here as well.
Okay.
So they were, and what's interesting about their blockchain was essentially it's focusing on financial transactions.
Right.
And the speed. But for people out there is your Visa and MasterCard who are doing millions of financial transactions every second, or they cannot be using a blockchain whereby the gas fees are too high to do these sort of transactions. So, and I think that was part of the problem as well for the financial sector coming into, the new technology of blockchain and Bitcoin and Ethereum, etc. is since we've been doing the early day tokens. And at some points it was costing us like $70 to do a minting. It was just like a crazy fee. Now I appreciate things have changed, it's still gone down, but it's still not getting down enough that you're going to want to switch your transactions on MasterCard or Visa to being on chain because the cost is going to be too high. But, Hedera, that's interesting is their cost was essentially next to nothing. And their thing is to try and develop something whereby financial institutions would want to use their blockchain because of the security, but also because essentially the fees and the gas fees, etc. there as well.
Yeah, it has to be efficient. And that's one of the reasons why Visa is piloting and looking into processing USDC, which is stablecoin transactions, but on Solana instead of on Ethereum, because it's fast and cheap. It takes virtually no time, milliseconds, to process a transaction and settle it, and it costs them almost nothing to do so. So Visa is looking at doing it on Solana. You mentioned Hedera, which I know is a different, a little bit of a different technology in terms of their consensus algorithm and such. But like you said, they're into fast and cheap. Right. We need this to be fast and cheap because we know for processing those types of transactions, it's important. When we look at Bitcoin and even the Ethereum mainnet, they're not necessarily fast and cheap as compared to these other chains, but they're more decentralized, more secure, and can be the settlement layer. So I think what you're going to see is a combination of different chains, whereas something might process on something like Hedera or Polygon, but then ultimately settle on Ethereum or something. I think, and that's where I talked about Chainlink and their ability to bring these chains together such that someone can create a token or process transactions on one chain because it's fast and inexpensive, but know that I want to settle on this other because it's safer, right? So you're going to have a combination of different chains, just like we see a combination on the internet, right? Like you and I can, I can hold an asset, and in that particular database might be built on Oracle or something like that. But I can just as easily transact or move those assets or buy a book or whatever, utilizing something that is built on top of Microsoft or SQL or some other database like that. So there's going to be the same kind of protocols built on top of blockchains, whereas you or me or someone else is going to get to issue tokens or process transactions on the chain that makes it most efficient for them, but settlement might be on another chain.
Yeah, no, I agree. I think that's key for adoption. I remember when we developed the first project for essentially hashing barrels of oil on the blockchain, and we developed our own blockchain. We set it up with a company from India at the time. They were working for the Indian government. But when we started to use it, two mistakes coming back is one, it just became slow once you started to actually hash stuff on chain on your own blockchain. Because back in the early days, everyone's sort of developing their own blockchain. It wasn't just sort of solidifying for it. And then the other thing that what we noticed was we just went into too granular detail. Like, who cares about hashing a barrel of oil on the blockchain? It's like that type of information. And I think that's the other thing that's actually starting to happen is we're starting to work out that what do we need to hash on chain and what can we actually run off chain, and even the exchanges themselves. And we were speaking a little bit about tier 2 exchanges earlier, is transactions on exchanges stay in the exchange. It's only once people are actually taking those tokens out into their wallet off the exchange that you actually see that transaction on chain, which is a lot better there rather than just like millions of transactions on a lot of these exchanges as well. I think the financial sector will start to work out what do they have to keep in central databases, what has to go on chain for the transparency piece, and where does it work best. When it first came out, it felt like everything had to go on chain. And that's just not the case.
Right.
You know?
And it felt like everyone had to build their own chain, whereas now you can build on top of others and figure out
they're
what's most
better.
efficient.
Yeah.
Exactly. It's better. And you need that interoperability. I need to be able to take my tokenized version of a BlackRock fund and potentially use it as collateral to get a loan, which means I'm going to have to be on the same network where the pool of loans is. Right. I'm going to have to be on, Ethereum or Polygon if that's where the pool of loans is for that particular asset. And we're going to see where the money flows, where the pool of assets flow. And I think the likes of BlackRock are going to build their tokens on whichever network is best for them. And the interoperability is what we're going to need.
So that's perfect then, Adam. So that's us coming up to the end of the show again, Adam. It's been fascinating to obviously get your insight into the crypto and blockchain market. Is there anything else you want to add? How people can find out more information about you, Adam?
Look, they can come hit us at Interaxis.io and learn more about courses. We have a newsletter that goes out several times a week talking about aspects like this and how they impact financial professionals, whether those are financial advisors, accountants, bankers, attorneys. We do those. We do courses to teach. We'll be probably going around the country this year teaching financial professionals in person as much as we can. So check Interaxis.io and you'll find all that information.
Perfect. Thanks again, though. Well, thanks again, Adam. Appreciate you're a busy guy, and thanks again for your time.
Oh, thanks for having me on, Alistair. Love it, and honored to have been the first and to keep continuing to come back.
Yeah, hopefully not the last, that's
hopefully
for sure.
Not the last time.
Yeah, that's it. Okay, well, thanks again then, Adam. Thanks to everyone out there. My name's Alistair Caithness. You've been watching Boom It's on the Blockchain. Have a nice day.